Why the 2027 chip tariff delay is a bigger deal for the U.S. than it looks. The hook, the consequence. Your retirement portfolio and the price of your next smartphone were just granted an 18-month stay of execution. But the cost of this mercy is a complete surrender of American energy independence. While the headlines focus on the Trump administration delaying new semiconductor tariffs until June 2027, the real story isn't about chips. It's about a desperate trade for the batteries that keep the U.S. economy breathing. Explicit judgment. I am labeling this 18-month delay as a short-term win, long-term risk. Yes, as always, who pays the price? In the short term, Nvidia and Apple shareholders are the winners. But the group absorbing the ultimate cost is the American taxpayer, who is now funding a massive state-sponsored scramble to rebuild a domestic supply chain that we should have started a decade ago. We are essentially paying China to keep the lights on while we try to build our own light switches. The logic, the battery trap. Let's look at the power AI paradox. The U.S. is currently building data centers at a rate never seen in human history. We are talking about facilities that pull more electricity than a mid-sized city. To keep these brains from crashing during a power surge, you need massive battery backups, known as BESS, Battery Energy Storage Systems. Here is the behavior we are seeing. Despite the tough talk from Washington, U.S. imports of Chinese lithium-ion batteries just jumped 75% this year. The government isn't considering a dependency. They are managing an addiction. They delayed the chip tariffs because they realized that if they hit China too hard on semiconductors now, Beijing would retaliate by cutting off the batteries. High retention line. America has designed the world's most advanced brain, but we've left the heart, the battery, in the hands of our greatest rival. The truce illusion. Aggressive scope. Focus on 2027 deadline. Why June 23, 2027? This isn't a random date. It is a strategic countdown. By setting a 0% tariff rate today, but promising a massive hike in 18 months, the U.S. is forcing companies like Nvidia and Tesla into a forced migration. Government data shows that for a project to qualify for tax credits in 2026, it must have 55% non-Chinese content. By 2027, that jumps to 75%. The administration is using a carrot-and-stick approach. The carrot is 18 months of duty-free trade. The stick is an unspecified, massive tariff that will make Chinese tech mathematically impossible to import by the end of 2027. Deep analysis, power word, hegemony. This is a direct challenge to Chinese hegemony in the legacy chip market. While we fight over high-end AI chips, China has been quietly monopolizing the cheap chips that run your car, your microwave, and your power grid. The U.S. is finally admitting that we can't win a tech war if we can't even build a toaster without Beijing's permission. The market behavior. Look at how the markets are already reacting. This isn't theory. It's cash movement. Lithium recovery. Lithium prices, which crashed in 2024, are finding a permanent floor as U.S. companies lock in long-term supply deals with domestic mines like Thacker Pass. Infrastructure pivot. Hyperscale data center developers are no longer just buying land. They are buying their own power plants. They are behaving as if the public grid is already broken. The truce rally. Tech stocks are hitting record highs today, not because the trade war is over, but because the uncertainty has been replaced by a deadline. Markets love a deadline because they can price it in. Forward pressure, the ending. The next move to watch is the January meeting between Trump and Xi Jinping. If China doesn't agree to ease their own curbs on rare earth metals, the stuff we need to make those chips at home, expect that 2027 truce to be torn up before the summer. Most coverage stops at the headline. This channel focuses on consequences. If that's useful to you, you'll want to subscribe.